You're listening to Capital Topics, episode number 39. This is a bi-monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the following points. For our first topic, we'll provide you with an update on the adoption of TFSAs amongst Canadians, its misunderstandings and common mistakes. And next, we'll review your pre-retiree guide to the new retirement. Part 1. Enjoy! Hello, James. How are you today?
I'm good, François. How are you?
I'm very good, thank you. So, for our first topic today, we'd like to talk about the tax-free savings account, TFSA. First, we would like to discuss how Canadians have adopted it. Then we'll address some of the misconceptions and errors being made while investing in them. So before I cover the most recent statistics on TFSA's adoption amongst Canadians, here's a quick recap of what TFSA is all about. TFSA were introduced by the Canadian government in 2009. It may surprise some people, but it's a registered account under the tax code, just like an RSP. It was introduced to encourage Canadians to save. The main benefit of this type of account is that any investment income growth when earned inside the plan will not be taxed, and withdrawals have no immediate tax consequence. So it's a great tool to make your money grow tax-free because you will not be paying taxes on any capital gains, interest, dividends earned on the money invested in that account. There is an annual contribution limit for 2022. This limit is set at $6,000. If you don't contribute to your TFSA in a given year, your unused contribution room accumulates, meaning you could contribute more than the annual limit in the next year. If you're a Canadian resident age 18 or over when TFSA were introduced in 2009 and have never contributed, you would now have $81,500 in contribution room.
Well, you know, François, there's nothing better than tax-free. And of course, legally. A lot of people may be cheating on their taxes. That's a different story. But you must take advantage of this opportunity. And really, it's the compounding effect of exponential geometric return that's really starting to pay off. And we see this clearly when we do long-term retirement financial protection. So it is, as they say, a no-brainer to open a TFSA and to maximize your contribution. So today we're going to share some do's and don'ts with our listeners, but really you should be focusing on maximizing this as much as possible.
Totally. It's really a no-brainer. But that being said, it seems from the latest data from Canada Revenue Agency, CRA, that most TFSA holders don't maximize their contribution. CRA's most recent statistics for the 2019 tax year highlights that across all income groups, only 9% of TFSA holders that maximize their contribution room available. And for the wealthiest Canadians earning $250,000 and more, only about 30% of TFSA holders had maximized their contribution. So amongst those holders, the average TFSA fair market value per individual was close to $23,000, and the unused contribution room was near $38,000. For the biggest earners, again, those with $250,000 a year of income or above, the unused TFSA room was close to $22,000, and the average fair market value was around $50,000.
Wow. Well, I'm really surprised by these facts. Initially, when TFSAs were launched, I could understand that people were not prioritizing their TFSAs. The contribution room was only $5,000 in that first year, 2009, and by 2012, 4 years later, the accumulated, contribution room was only at $20,000. So, for people that are very poor, $20,000 is a lot of money. But for, our client base, this is like, well, why should I really bother? Is it that big a deal? But now with $81,500 of contribution room, the TFSA should be a priority.
Totally. And I think it should be fairly easy for individuals, especially those in the higher tax bracket, to come up with 6,000 to contribute to a TFSA. I say this because if you're making 100,000, 150,000 or more a year, and you're saving for retirement by maximizing your RSP, your income tax refund should be big enough for you to contribute to your TFSA. It's probably even big enough for you to give money to your spouse for their contribution.
Well, again, that's a brilliant point you make, François, because it's a great income tax splitting strategy. Again, you can gift to your spouse or common law partner money so that they can contribute to their own TFSA. The Income Tax Act attribution rules will not apply. The amount you contributed and any earned income from that amount will not be allocated back to the gifting spouse by the CRA. So that's, again, a really great idea.
And the next thing I wanted to discuss about TFSA is some of the misconception about them and the errors investors are making when using them. To me, the first misconception probably comes from its name. I wonder if calling it a tax-free savings account was well founded. I'm guessing that the word here, saving, is what bothers me. I think they could have named it differently. Perhaps it should have been named tax-free retirement account or tax-free wealth building account. Nevertheless, I think the current name gives people the wrong impression or perception about the account. I think it gives the idea to the non-initiated that it's like a checking account or a regular savings account from your bank branch. And on that front, I don't think that the banks are helping to demystify this either. They often promote them as being a great vehicle to save for short and medium-term goals, such as a vacation, a big-ticket item, or for an emergency fund. My opinion on that is that I would advise you not to use your TFSA room for these short-term goals. I think it would be wiser to use your TFSA for longer-term goals and let the money grow tax-free over time to benefit from the power of compound growth. If you are investing for short-term goals, you should be looking at protecting your capital, and by doing so, the financial instrument you would be using will not generate returns high enough to justify the use of your TFSA room.
Well, François, this is, again, very important for our listeners to understand the power of using the TFSA as a long-term tax savings vehicle. Effectively, your tax savings would not be optimized. There's a big difference in tax savings for letting your money grow tax-free at a compound rate of 7% a year, for example, by investing in equities for the next 20, 30 years versus the tax savings for investing at 1 or 2% for the next 3 to 5 years. But more importantly, and I had a case this morning, one of our longstanding clients, they went and opened their TFSAs at their bank. We manage a large account for them. So we're doing their annual review meeting, basic step. What's your update on your statement of net worth? What's the value of your TFSA? The value of their TFSA was, and they maximized since 2009, was $93,000 for him and $94,000 for her. So they're saying, well, what do you think of that? Well, with us, and again, the last decade to the end of December 31st, 2021 was a great decade. There was excess returns over that period. So clients are sitting around $125,000 to $130,000. So you get, imagine both spouses. So you're talking $240,000 to $260,000 of joint total money that's compounding now going forward. So we've had this like 12-year period to the end of 2021. And now we get another $6,000 to put in. But if you're going to earn, and let's use as an example, 5% on that 250,000, you're going to get, and I'm using the average of the two there, between 240 and 260,000. So 5% of 250 is $12,500. Well, the maximum room is 6. So you're putting in your gain plus the 6, you get 18,600. If somebody's starting now, they're putting the 6 in. It's like night and day. So that the people who haven't done it will never catch up over the long term. And as I said earlier, when we do the long-term retirement planning, at end of life, people have these large TFSAs and they have a large value, usually in their whole principal residence, and both of them are tax-free, assuming that tax code doesn't change. And clearly, as these tax-free savings accounts get larger, the government's going to start to look at this and, oh, do we really want to allow, all these wealthy, people to have a tax break of that nature, which is true tax savings. It is tax-free.
Mm-hmm. Exactly. And the other mistakes that investors are making while investing in their TFSAs, one of them is buying very speculative investment in the hopes that they get a 10 bagger and avoid paying taxes on that big gain. However, the likelihood of that happening is very, very, very slim. And the probability of losing money is quite high. The problem with that is, for me, is twofold. One, the loss in your TFSA is unrecoverable. Unlike in a taxable account where your capital loss can be used to offset capital gains, in your TFSA, the loss can't be used to offset anything. It's permanent. Second, the next problem I see is that when you lose money in your TFSA with a speculative bet, let's say you use your 2021 contribution of $6,000 to buy a penny stock and the company goes bust, well, you have just permanently erased $6,000 of contribution room.
Well, again, very good point that you make, François. In our most recent podcast, again, for our listeners, that was a very technical piece on diversification and the history of inflation by us sharing our thoughts on the summary of the Crédit Suisse for annual yearbook of global investment returns. But one of the things they highlight is some of the academic evidence where, investors are not diversified. And so they make concentrated bets, and concentrated bets, you can create massive wealth, but you can dilapidate capital, and you can't recover from dilapidating capital. So the small consolation is that, you'll get 25% of your loss back because you'll be able to carry forward the loss, indefinitely or back 3 years. And so again, getting back to my basic illustration of 81,500 invested today, and 6,000 every year at a 7% rate of return annually over 5 years, that gives you a little over 791,000.
Wow.
And that's for contributions of 225,500. So you'd think you've got over twice the value of your contributions in tax-free gain. And again, assuming the government doesn't change the rules over time. So the magic of compound interest is very powerful, but it's even more powerful when it's pre-tax and it's not only pre-tax, but tax-free.
That's exactly right. Another common mistake, James, is a TFSA investor must be careful on how much trading they are doing in their accounts, because if you trade too much, CRA could interpret that your trading activity constitutes a business. And under the tax rules, if the trading in your TFSA is considered a carrying on a business, you could be subject to pay income tax on your business income.
Well, François, you're getting very technical on the tax side about, are people investing, or are they an ongoing investment business and trading? But clearly the government is looking at they have all the data on, and they can flag who are these ultra large tax-free savings account. And they've in fact made public statements since the most recent federal budget that they're going to be looking into that to make sure that people aren't abusing of this. And so from what I can gather, there's no specific set criteria for the determination as to whether an individual is carrying in a business of trading and investments inside a TFSA. However, the CRA could evaluate the following factors: the frequency of transactions, the duration of the holdings, the intention to acquire the securities for resale at a profit, the nature and quantity of those securities, and the time spent on the activity. So this really doesn't apply to the vast majority of people, but it's something to keep in note, that if you are an active trader and CRA deems you to be, doing that as a living, and that's your business, that clearly if it's in the TFSA, you might be at risk.
Yep. Okay, thanks, James. This sums it up for TFSA for today. In our next podcast, we will review TFSA and the tax issues at that. Okay, next, for our main topic today is the Pre-Retiree Guide to New Retirement Part 1. We're going to cover this great topic in 2 podcasts. In today's podcast, we will cover the framework for the psychological aspect of retirement planning. And in our next podcast, we'll cover the financial aspects. James, what should our listeners know about how to best be prepared for an imminent retirement? Over to you.
Well, this is a topic that we've wanted to tackle for a long time on our podcast. I mean, people spend a lot of years saving and planning for retirement, what we call the accumulation years.
Mm-hmm.
And as they get closer to retiring, there's a lot of emotions that start coming out, again, around what to expect in this new stage of life. So, in my case, after more than 25 years of being an advisor, helping clients to plan for retirement, and then watching them make the transition into this new reality. In fact, it's a big blessing. I've had clients for more than many of them over 25 years, and I've seen them go through the life cycle of an accumulator, working, career, family, and then easing into retirement, and then living off the capital, so to speak. So I can tell our listeners that every client situation and the planning solutions are different for each one. But the fears and concerns, both financial and psychological, have a lot of similarities.
James, we've mentioned new retirement, but what do you mean by new retirement?
Okay, well, here I'd like to share some facts, and I'm going to quote this a few more times in today's podcast. But the large U.S. financial firm Edward Jones, with a consulting firm called AgeWave, published a report called The Four Pillars of the New Retirement. In fact, I think they did in 2020, but they updated it post the first year of COVID, and they published it in June 2021. So in the last year's report, they stated that the majority of retirees describe this life as a completely new chapter in life. What makes today's retirement new? Well, the survey states increasing longevity means more people with longer retirements, making retirement a more important stage of life. However, it's not just the massive size of the boomer generation that's changing the face of retirement, it's their attitudes and aspirations. They enjoy more opportunities and more choices than any previous generation for shaping retirement to suit their needs and expectations.
Yeah, well, in our society, however, if you look up the definition of retirement, you'll be hard pressed to find a positive one.
Well, absolutely. I mean, there's an expert in the field, Reed Stone, who co-authored a book called The Retirement Challenges, a non-financial guide from top retirement experts. And he wrote an article recently highlighting some key facts around this negative image about the word retirement. And he says, retirement connotes a conclusion, no longer contributing, your best is behind you, nothing to look forward, not being active and engaged in life, being alone. So again, all negative stuff. So he also comments on ageism, and simply by your age, society's messages indicate you are finished. He goes on, the current lives and futures of most retirees do not jibe with these definitions and words. And I agree with what he says. I see that with our clients. Like, I am super impressed at the lives they are leading. They are rich, they are active, they're vibrant, they're just, I'm very jealous in many ways because I see all the things they're doing. I like to do that. I like to turn around and do that. So again, it's a lot of negative out there around it.
Yeah, well, you just have to think about how retirement has been advertised and the message received throughout your lives. These messages can have a powerful impact on how you perceive retirement. It is for most people the single largest goal that they have in their lives.
Well, again, the aspect of saving for all focus, save for retirement in our business. Traditionally it's all financial advice. So that's why today's podcast, it's extremely important. It's about the non-financial side of it. And in many ways, you got to be thinking about that aspect before you jump into the financial, objectives. So again, it's very common to focus only on the financial aspect. So, but preparing for retirement is more than just saving money. People are living longer, working, and looking at retirements that may span 30, 40 years.
Yeah, so this speaks to the new retirement, taking a different approach to retirement.
Absolutely. A different approach is really the message. So a comment we we hear often from new retirees is no one warns you how difficult it is to start spending down the money you've built up. Just think of it. Flipping the switch mentally is incredibly difficult. It sort of triggers a fear response in your brain, right? And it brings us to the importance of thinking about how you want to live at retirement.
Yeah, this goes way beyond the traditional retirement financial planning or modeling. We address when we address the classic question: will you have enough money? Will you be at risk of running out, and so on?
Well, exactly. Those questions are really classic. No, but let's go back to that Edward Jones age wave study where the 4 pillars of the new retirement survey. Most pre-retirees are not thinking, according to the survey, they're not thinking comprehensively about these non-financial dimensions of retirement. There is a disconnect between what retirees say is important and what pre-retirees have thought a great deal about. So, once you're retired, oh, wow, this is important. But before, it's like you don't even think of it or put any time or energy.
So what should our listeners do, James?
Well, let's get back to the expert and author, Robert Reed. He recommends that you first create a vision of what you want retirement to look like. The money and portfolio strategies can then be designed to make your vision come to life.
Yeah, so how much you need, when, and for how long is determined by first creating a vision of their ideal life in retirement?
Exactly. Now we are ready to address the financial questions like how much do you need? So if you've got that vision, then okay, what is it going to take to support that financially? What is that going to cost? So that's where we get to the traditional, financial planning work involving figuring out and estimating the retiree cost of living. And the ideal approach could be to start to live now based on what you want in retirement. It's not possible for everybody, but if you could, that would be ideal. If you can, live a lifestyle now that affords you meaningful work-life balance, because that's what we're seeing with our retiree clients. That's what a lot of these experts and the study from surveys is saying, that you want that, you have that balance, that freedom to choose what you do with your time. So again, if you're already in that mode, in your towards the end of your career, that's really, really, really helpful with the transition. But again, it's not always possible for most people. Estimating your cost of living, and just a heads up, is really a lot of work. Pulling out your credit card bills and figuring, what am I really going to spend at retirement? In reality, you're only going to really know what it is once you're retired, because you're going to see how things are. And there's always surprises. Executives, for instance, who work for an employer for a long period of time with expense accounts, all of a sudden they got to pay for all the stuff that they were usually claiming on expense accounts. So a good advisor will be able to help their clients run through scenarios to figure out that. And we'll talk about this in our next podcast in terms of the spending scenarios and financial projections. So the next question, is when to retire. And again, there's a financial aspect, but there's a psychological aspect to this. And often the client's decision to retire is determined by a number. When my portfolio is worth this much, I can retire. Or, I need to get this much before I can retire. And a certain age or date that they want to retire is also like, well, I want it by that age. And the joke I share all the time, clients are in their 40s, I retired at 55. They get to 52, 53. Oh, well, maybe 57, 58. And by the time they're 63, well, I don't want to stop working. So again, it really depends on the individual.
Those numbers, James, the portfolio size, the age, the date, are not necessarily wrong, but using only those numbers to take the decision to retire is incomplete.
Again, this is what the experts on the non-financial side of retirement are saying. The 4 pillars of the new retirement survey concluded the following. The vast majority of retirees say that in addition to saving for retirement, it is important to think about what they will do to stay healthy, where they should live, how they will maintain or improve family relationships, and the activities that will give them a sense of purpose. This is the whole really deep, healthy living, take care of yourself, spend time with loved ones. This is critical stuff to have a
Mm-hmm.
successful retirement.
So the question here for our listeners is, have you been thinking about these non-financial dimensions of retirement?
Well, I came across an article last fall. It was published in the Wall Street Journal in October, and it really, really interesting. And it was written by Dr. David Eckert. Now, and the title, by the way, of the article is I Spent 44 Years Studying Retirement, Then I Retired. So this is going to be good. The guy's not a financial advisor. He's a sociologist and gerontologist at the University of Kansas, now retired. And so here he is, supposed to know everything, and now he retires. So I will quote a line from the article. Dr. Eckhart says, I am now retired for a year and a half, and if anybody should have known what to expect in this new stage of life, it was me. Through surveys and interviews, I've explored how men and women prepare for, enter, and adapt to retirement. He then goes on to highlight what transpired, both the expected and the unexpected. So I'm going to start with what he expected and what are wise things that our listeners should consider if they're early retirees or pre-retirees, I should say. First off, he says about developing a routine. So successful people who've had careers, who've had structure in their life around the commitments they have professionally and family. He says, yes, a daily routine has been helpful while nonetheless maintaining relaxed hours within that routine. If the walk starts later or the crossroad takes longer, so be it. So again, you don't have that pressure of, it has to absolutely done now, but a daily routine is again something that he expected would be beneficial, and he attests that it is. Now, the second one I'm going to call developing your elevator speech. When we're in business and we're trying to develop new clients, the basic training talks about developing an elevator speech, which means I can explain what I do in 2 minutes or less. What he recommends is that retirees need to develop that because people are curious. You used to be doing XYZ. You were an executive. You were an entrepreneur, owned a business. You're a medical professional. And all of a sudden you're retired. So everybody's looking at, oh, you're retired. So he says that it's really important because as I expected, and I'm quoting him in the article, I've also faced friendly questions about my new status and about how am I doing and what am I doing. I have had to devise an account of myself that I find appealing, even if not telling the whole picture. But it is the right place for us right now. So what he's really trying to say here is this is your mission. This is your sense of what you're up to and what motivates and what drives you. Because again, this phase of life could be 30, 40 years. So,
and I totally agree with that because it speaks to your commitment, to your comfort, to what you really want to do with your life going forward.
So the other thing that he said, what was expected, was the where to retire. So that is because you may want to move. Do you want to be closer to your kids if they've moved around across the country? Do you want to be closer to friends because you're going to socialize a lot with them? So the thoughts about moving are commonplace, and today, that's kind of normal. There are regions in Canada where people find they've got extraordinary wealth in their homes, and they don't want to get tied up with home equity loans because that's most of their capital's tied up in the house. They don't want to tie the high cost of reverse mortgages. So they're really going to downsize, but you can't turn around and buy something in the community you're selling. You got to move away a certain distance because that's where you'll be able to sort of downsize, but also take the tax-free, proceeds that you're not going to need buying the new house to help support your retired standard of living.
Yeah, totally. Some may want to downsize their homes, but they can't afford to purchase a new one because they need the equity in their homes to support their lifestyle.
We see that not a lot in our market here yet, but I could see it happening as the price of houses sort of go up. So it is happening a lot, and we read a lot about it happening, particularly in markets like Toronto and Vancouver. So the next thing that he highlights that's really important is to think about your relationship with your spouse. So, and here I'm going to quote a classic joke. And the first time I saw this was in a cartoon in an American financial magazine. So here it is. I married him for better or worse, but not for lunch. So that's, a classic situation where the husband was the breadwinner and the spouse was the homemaker, and all of a sudden she has the run of the roost and he's not home full time. He's got nobody to manage, so he starts managing his wife. So obviously that's not a winning proposition for the spouse. But it's amazing how it resonates. So for me, I Googled it recently, and it's amazing. Like, this joke goes way back, even before 20 years. There's all kinds of history. I don't know who it's really attributed to as the author, but it's really taken on a life of its own. But it's very powerful in my mind, and I use it in my practice because it's an icebreaker for between the spouses to say, hey, wait a minute, let's have the real conversation, because there are going to be adjustments. So Dr. Eckert talks about this, how he's had to adjust. And I've read other articles and material on this. So it's a fairly common topic. How did the spouses adjust to their new life where they're spending a lot more time together as compared to their pre-retiree years where they were very busy, because now most often both spouses are very active professionally.
Yeah, I've heard you over the years, James, say this joke quite a bit to clients.
But it works. It's really relevant.
It does.
So now let's look at what Dr. Eckert said was unexpected. And these, I think, are really insightful. So the first one we don't think of, but it is really important. When you're working in a professional environment, you've got all these IT specialists. If your computer freezes, or you get malware, or you've got a phishing, risk on your PC, or your tech just blows up and it's not working, you just call him, what do I do? What do I do? Well, all of a sudden he says, I find myself at home and I'm my own IT specialist. And, he, in the article, he says he's 74 years old. So, some retirees are really technologically, competent, some are not. So one of the projects you should set about is really getting yourself set up with, particularly in this day and age, having proper cybersecurity protection, having access to a techie support service if you run into PC issues, and really building up your cloud-based digital platform so that you can save all your documents digitally. Again, we'll talk about that in a future podcast about estate planning, where if you have things administratively in the cloud saved and structured digitally, it's far more efficient than piling boxes of papers accumulating over the years. So the next thing that he talked about is claims on your time. And it was really unexpected, where you really got to be fierce about what you're going to commit to. And he was talking about, he likes gardening, and he goes to the botanical garden locally in his community, and he was going to volunteer, but then you'd have to be there every day on such a date, and you got commitments. And he says, I wasn't ready to do that kind of stuff. In the 4 pillars of the new retirement survey, it reports that retirees overwhelmingly state that the great prize of retirement is freedom from daily obligations. No more schedules. My time is my own. My clients, share these feelings about having to be fiercely protective about what commitments they make. And Dr. Eckart's, example of the botanical garden volunteering, my clients share that with me, that they've never been busier. And so what he says in the article, and I'm going to quote him again, there's the awareness that retirees have about claims on their time. On the other hand, I'm protecting my options. After years of claims on my time from work, from family, I now see clearly why retirees are reluctant to obligate themselves. So I live with this puzzling ambiguity, as he calls it. The self-imposed pressure of work has lifted, even as I feel guilty about loafing too much. For now, I have 2 angels perched on my opposite shoulders. One whispers in my ears, relax. And the other says, shouldn't you be doing something?
Yeah, that's true, James. But I often hear retirees like you just mentioned saying that they've never been so busy.
Again, there's so much to do. There's so many places to see. How you spend your time. It's really an exciting period of life.
Mm-hmm.
It's a new stage. So when we talked about the definition and the negative connotations, we're seeing the opposite. Now, it's true we manage funds for wealthy people. If people don't have financial resources, if they don't have health, these things it is a period of life, which is a very big challenge. So again, as the boomers move massively into retirement, they're going to change how everything is perceived. So this leads to the final point that Dr. Eckert, shares, which is avoiding the retiree identity. And here, let's get back to some of our clients. And we often hear them say, I'm not retired. So then they tell us how busy they are. And the common refrain, as you just said, and I said a few minutes earlier, I've never been busier than since I retired. Mm-hmm. And some retirees, if they can control events, plan a clean break from what went on before and move into new directions. But for a lot of clients, again, for those who manage to plan it so that they transition into retirement, it's just a continuity. And here again, let's hear what Dr. Eckert says about his situation. And again, I find it very insightful. He says, in my case, and knowing a lot about the experience of others, I foresaw continuity for myself across the transition. I'm the same person, the same interests, the same relationships. What is clear now is that I have arrived at a place that is further than I had imagined from the worker that I was, from the setting where I worked, and from the younger man that I had been. I have arrived only to embark. Again, I think that's very powerful. Mm-hmm. And pre-retirees should be inspired by those words, that this next phase of life is going to be really exciting.
Well, I hope this today's podcast is helpful to our listeners. The insights shared today can also serve retirees and accumulators. Thank you, James.
My pleasure, François.
So that's it for episode number 39 of Capital Topics. Don't forget, if you'd like to submit question or suggestion for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in today. And please join us for the next episode in 2 weeks when we will continue part 2 of the pre-retiree guide to the new retirement. See you soon.